Hello and welcome to another episode of Citywire Macro Talk. Today, I'm quite pleased to welcome Andreas Steno Larsen to the show. Andreas was on the Citywire platform before, and I'm quite looking forward to talking to him today. About Andreas, he is the senior editor of Realvision and also the CEO and founder of Steno Research. Andreas, how are you?
Good. Thanks for having me, Lucas.
Cool. Andreas, let's lose no time and jump directly in. I guess 2 days ago, the bevor Bank of America published a new research piece where they evaluated a survey of current positioning of fund managers. And the title of this research piece was bearish, but not apocalyptical bearish. So sentiment seems still to be pretty stretched. Many institutional money seems to be trapped on the short side, but on the other hand, the market is basically rallying for the past 3 weeks. Maybe give us a broader picture. What do you see right now?
Well, I mean, first of all, when the market rallies more than 20%, if you take the Nasdaq, for example, it is, of course, a reflection of some big whales buying into this rally, because otherwise you wouldn't get such a big rally. So I'm not entirely sure that the recent positioning survey from Bank of America is entirely reflecting the actual truth here. But when that's said, I think it's fairly clear that this is one of the most hated rallies in modern history when it comes to equities. You can see that from the sentiment on various social media channels, but you can also see it when it comes to these positioning surveys. Most people have been caught on the short side. It's very clear that most institutional managers, they are underweight in their equity positioning relative to historical standards. And therefore, this has obviously come as a surprise to many. I think the reason why we've gotten this rally is that we finally see signs of inflation abating in the US. The Europe is an entirely different question. And that comes as a huge relief to many, given that we've seen upwards surprises to inflation basically throughout the first half of the year. And I think that's a game changer for the market psychology. And when it comes to the developments in inflation, I think it's pretty fair to look back to the early 80s and the mid 70s to find similar environments to sort of assess when it comes to this current rally. First thing being that when we are in a scarce supply situation when it comes to energy, as we are currently, I think it's fairly obvious that we will move from very material inflation to suddenly very material disinflation, but in very sharp swings with like 6-9 month cycles. And we saw that during the 70s, we saw that during the early 80s, very swift cycles and a very swift change in market psychology every time there was a peak or a trough in inflation. So I actually stick to my view from the past few weeks that there is more to go in this rally, because if inflation is fading now, that's everything the market will chase.
Quite interesting views here at the beginning. If we talk about inflation and disinflationary forces going forward, we also have to talk about the topic of maximum hawkishness priced in by the Fed potentially. I like to look at the Fed funds futures rate 30-day, which are traded as futures contracts. You look at the forward curve, you can currently see that the pivot that is priced in is around April of 2023 at the rate of about 3.5%. Currently, we're up at 2.5%, so that means 100 basis point rate hike is still in. Do you think that's realistic? And is this also your base case?
Yeah, I think it's very realistic. If I'm right that everyone will chase this story of disinflation now, then the Federal Reserve will ultimately also chase this story in their policy making. But if I'm also right that we will see these very swift changes of sentiment and very swift changes of business cycles, then I'm unsure whether this pivot will last for more than, say, 6 to 12 months during 2023 and 2024, because as soon as you allow the market to chase this disinflation story, it will sort of return inflation with a vengeance. if the supply side issues are not solved. And I frankly don't really see any light at the end of the tunnel when it comes to the supply side story of everything related to energy. So the only reason why there is a bit of light at the end of the tunnel right now is the demand side. The demand side is more or less falling apart. And I think that's the very clear signal sent by most commodity markets, even though we've seen a small rebound in industrial metals. But this picture is really clear when you look at market action in commodities since mid-June.
I would fully agree with you here. I mean, like the fundamental problems in the commodity sector are mostly not treated well by now or not solved. But there's visible demand destruction going on, and we can see that the best at the picture of oil, actually. I saw a tweet of you where you highlighted the correlation between the oil price and inflation expectations, which is basically the same chart. This also confirms the deflationary forecast you have by now. If we think about deflationary environment going forward, what's your take on bonds?
Well, I basically like to buy bonds with a horizon of 3 to 6 months, since there is this very close correlation between the energy markets and the long-term inflation expectations. And I think we agree, Lucas, that when you look at the growth cycle and the demand side of the economy, then we won't get any good news over the next 3 to 6 months. So that's one part of the equation when you look at long bonds. The second part of the equation is the inflation component of the long-term expectation formation for long bonds. And I also think there you'll get at least decent news over the next 3 to 6 months. So basically on both parameters, you have a green light to buy bonds.
Cool. What quite worries me is that usually in the past, the classic cycle was that bonds basically bottomed out first, then followed by equities, and later on by commodities. Now it seems like stocks are doing the first step here. Is this something you're following as well?
Yeah, it's a very good point. It may be related to the fact that we have a different inflation regime compared to what we had during the 2010s, because you're absolutely right that if you look at the peaks and troughs in bonds versus equities, at least over the past, say, 10 to 12 years, the playbook was exactly as you described it. But it seems as if something has changed when it comes to that playbook due to the inflation running at much higher levels. It also makes it much trickier to figure out the exact timing of the pivot from the central bank, because, I mean, we need to go back decades to find a pivot from a central bank with inflation running substantially above target, right? Which is essentially what the market envisaged right now. And I think that's the reason why everybody is struggling to really figure out how to asset allocate in this environment, because the old 60-40 portfolio just clearly doesn't work.
Sure, yeah. Andreas, I know that you also big in the currency space. Let us maybe talk a little bit about euro US dollar. In the recent year, we saw King dollar dominating across every market basically. I saw that you're actually not in a long dollar camp if it comes to the cross rate with the euro. Could you explain a little bit why you think that the euro has some potential to bounce here?
I mean, first of all, I've been short euro dollar for like 18 months in a row. So this is a big change for me to at least go square. I don't have a long position in euro versus dollar per se. I have like a more broadly speaking short dollar position on now. The reason is that the market psychology around the US CPI will also change the FX picture, if you ask me. And if you look at the relative picture between inflation in Europe and inflation in the US, then I think the spread between the two will likely widen during the fourth quarter. Energy effects onto the CPI, they lag quite a bit in Europe for a bunch of reasons. If you take the UK as an example of an inflationary story into the fourth quarter, then you have these very clear price jumps every time the politicians allow the price of energy to increase for the consumer. So they have these price caps that they gradually allow to rise. So that's one reason why inflation could continue upwards into the fourth quarter in Europe. If you look at forward pricing of inflation in Europe, it's probably stuck around 10% for the fourth quarter. Probably even too low if you ask me. And if you look at the forward pricing of electricity, natural gas, etc., it's basically priced to become even worse into the early parts of the winter. Why am I then at least leaning a little bit positive on the euro versus the dollar into such an environment? First thing being that I actually think that the European Central Bank will have to hike to a larger extent than the US Central Bank during the fourth quarter and maybe also the first quarter next year, because they will have to strengthen their credibility as an inflation fighter, even though this is mostly a supply side driven inflation in Europe. They have one objective and one objective only, that is to keep inflation low. They will obviously pair that with some sort of indirect help to Italy and other indebted currencies in Southern Europe. But the rate spread will likely continue to support the euro into the fourth quarter and into the early parts of next year. Second thing is that if you look at the electricity forward pricing, and I'm also keen to hear your take on that, Lucas, then if you look at the fourth quarter pricing of the peak load, so the price of electricity during the peak hours of the day, then we have electricity priced at more than 2,000 euros per megawatt hour in France, for example. It's a bit lower in other countries in Europe. But what I'm being told by people trading electricity is that it basically reflects the clear risk of a blackout of the electricity system in Europe at some point during the fourth quarter. And to me, that's as bad a scenario as you basically can price, right? We simply need to get that blackout to surprise on the negative side in Europe by now.
I agree with you. I mean, if we look at the energy markets per se, what there is currently traded is simply fear. The prices are astronomical high. I'm a big fan of correlations. And if I overlay the natural gas futures from Europe with the price of baseload electricity, for example, here in Germany, it's basically also the same jihad. So the whole gas flow dilemma, also from Russia towards Europe, is, in my opinion, also a big driving factor for the euro going forward. I think if the flows remain stable like they are now, Europe will be able to come through the winter, of course, with some sacrifice. But I think this scenario is already priced in. And if that holds true, I would also argue that there is more upside potential from the euro going forward from here.
Look, Lucas, let me add a thesis on the whole energy question. If you look at Russian exports of natural gas, the only feasible destination for those exports is still Europe. They don't have any material capacity for liquid natural gas in Russia. They don't have pipelines built in other directions. So it essentially means that Europe is the only client. So when I use my sort of craftsmanship analysis on the whole negotiation tactic by Russia in terms of natural gas, then I would argue that it is likely at some point during this winter, they will actually get back to the table and try and increase natural gas flows again, since Europe is the only feasible destination for that flow of gas. And ultimately, Russia will have to sell the gas to someone to keep the budget balanced and all that stuff, right? So I think it's a game of chicken right now, but ultimately Russia will be back at the table.
Sure. And I also think we should give Marco Papic here a shout out, because he got this picture really, really right.
Yeah.
Another pressuring market right now that's concerning me a lot is the Chinese property market. You also tweeted a little bit about what's going on there and where we probably headed. Could you elaborate a little bit on your expectations going forward?
Well, I think first of all, it's important to note that this is a crisis manufactured by the Politburo in China. They wanted to take down the property sector. Parts of the management in big companies such as Evergrande and other big companies in China, they simply became too influential. They became too rich, and therefore they decided to crack down on the very high leverage in these companies. It was a process designed all the way back to September 2019. So they decided to decrease leverage. They decided to try and orchestrate a price drop. And of course, they are now sort of at a crossroads, because we've entered territory where the population in certain provinces is very clearly angry with the situation. They've stopped paying mortgages on home building projects in, for example, the Henan province. So I would expect the Chinese authorities to, at some point during this autumn, to actually step in to underpin everything again. But it was very important for them to manufacture this crisis, and they want to take it to the absolute edge before they solve it again.
Great take, Andreas. I think if we talk about China, we also have to talk about commodities. The China credit impulse was one of the best leading indicators, basically, till 2021, I would argue, to judge where the general commodity complex is headed. The property market, of course, had a lot to do with that, as well as lots of basic materials are needed to build property. Do you think that the China's situation is also feeding to this general weakness in commodity prices at the moment? And another question I would like to add, do you have a general opinion on the commodity supercycle?
Yeah, I mean, first of all, if we look at the correlation between Chinese imports and the overall commodity cycle, then you get a very strong correlation, basically the same chart, to use your words, Lucas. And I think the reason why we saw such a material drawdown in most industrial metals from mid-June and into August was that the zero COVID policy worked with a time lag, right, in China. So I think China is important when you judge this, the cyclical component to commodities. I'm not as sure that the Chinese cycle is worsening from now. As you mentioned, we've seen a slight pickup in some of the early indicators of increasing activity in China. I don't think China will sort of solve the entire global business cycle as they've done before, but at least the domestic demand in China could increase into 2023. But if you look at the home building sentiment, to just take one gauge of economic activity related to commodities, then it's basically falling off a cliff in the US also. I would expect a setback for such activity in Europe as well. So by the end of the day, it's really hard to see who's the marginal buyer of industrial metals into the fourth quarter and into the first quarter of next year if this sentiment continues to worsen, which I find likely.
Sure. Maybe let's come back to the commodity supercycle thesis again. Currently, of course, commodity markets are rightfully selling off because slowing economic growth is the main driver at the moment. If you overlay the ISM PMI data, manufacturing PMI data with the oil price, the correlation is pretty tight. But what is your take on a longer term horizon? Do you believe in something like a cyclical commodity supercycle? Give me just a take on that.
Well, I find it likely that we have entered sort of new territory for commodities in general. If you look at forward-looking gauges of oil demand versus oil supply in, say, 3-5 years from now, then it is, I would say, crystal clear that we've underinvested in the development of new oil capacity, basically. If you look at the strength of bargaining power of the OPEC Plus group, then it's basically, if not back to the 70s, it's at least back to the early 80s, so thereabout. They clearly have bargaining power again, since the shale oil from the US is no longer sort of running the marginal price of oil as it did from basically 2015 and onwards, at least. So it is a big change of scenery when it comes to the oil space. It is also a big change of scenery on natural gas, obviously. The interesting thing here is whether Europe will be able to sort of shift away from natural gas as a resource in a matter of 2 to 3 years. I am very, 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 very skeptical on that. So it basically means that liquid natural gas will likely be bid up for a prolonged period. If you look at forward pricing, I know it's not necessarily an assessment of the actual price in 2, 3, 4 years of time in natural gas or in oil, then I would still argue that prices are fairly low in a forward perspective. So yes, we have a cyclical downturn right now, but the commodity supercycle is still a fairly feasible scenario, also since the geopolitical risk picture has basically changed to the worse.
I agree 100% with you. And maybe we should also add that the commodity, sorry, not the commodity, the energy component is very important for the agricultural side of the commodity complex, as well as for the metal mining complex. So this energy topic is really touching lots of commodities here in general.
And I think, Lucas, it's also worth noting that when you look at the demand for stuff like electricity, it's extremely inflexible. So even when there's a price increase of, say, 1,000%, which is more or less where we are at in Europe compared to the low levels of 2020, then demand probably drops by 2-3% max. So it basically just means that we cannot just turn off the energy grid. I mean, it's not a feasible scenario. So even when there's a supply scarcity, we will have to use more or less the same amount of energy as we did before. I know that there are some political parties trying to bring us back to the 17th century or thereabout when it comes to the energy question, but it's not a feasible scenario. You will not get reelected if you tell people not to use energy. So the only thing that you can do from here is to increase the supply. And I actually think by the end of the day, we will see investments in the oil and gas sector again. It is just a matter of time, and we probably need to get to the very edge of the cliff edge scenario before we take that decision.
That's very interesting. I haven't heard that one before, but let's see how it plays out. Quite interesting. Let's maybe finish off this interview with a last question I have. Andreas, what is your current highest conviction trade?
I'm long TLT, so the 20-year plus bond ETF in the US. I think that's a very good addition to a portfolio. I am also slowly but surely dipping my toes into US equities versus European equities again, as a consequence of this relative inflation story. I think it's a much more benign scenario for S&P 500 or NASDAQ versus, for example, the DAX in Germany when it comes to this relative inflation picture. So those are the two top picks I have right now. And then I am short the commodity sector in general via the SALL ETF. It's not particularly liquid, but if you take a small position, it's possible. And it's basically a broad-based position in short commodities.
Cool. Andreas, thank you very much for providing all these insights to our listeners. It was a pleasure, and I'm looking forward to maybe doing this again another time.
Yeah, I'm happy to be back. Lucas, thanks for having me.